Welcome to my advanced tutorial on the Digit Pattern Divergence Strategy using the LDP Binary Digit Pad. Today I'll teach you exactly how to identify high probability trades, when to enter the market, and how to manage your risk for maximum profitability. The Digit Pattern Divergence Strategy is based on a simple statistical principle. In a truly random system, each digit from 0 to 9 should appear about 10 times in 100 price ticks. When we see significant deviations from this expected distribution, we have potential trading opportunities. Let's start by looking at the LDP Binary Digit Pad interface. After logging in with your Deriv account, you'll see the main grid displaying digits 0 to 9 across the top, with different markets listed down the left side. Each cell shows how many times that digit has appeared in recent price ticks. The color coding is crucial for this strategy. Red cells indicate digits that appear less frequently than expected. These are our primary trading opportunities. Green cells show digits that appear more frequently than expected. White or neutral cells represent average frequencies. Here's exactly how to implement the digit pattern divergence strategy step by step. First, scan the grid for red cells with values of 4 or lower. These represent significantly underrepresented digits. The lower the number, the stronger the signal. Pay special attention to values of 2 or 3, as these are particularly strong anomalies. For example, if you see that digit 3 on the 75V market has only appeared 2 times, that's a potential trading opportunity. However, don't rush to place a trade just yet. Next, you need to confirm market bias by checking the even-odd distribution. Look at the yellow and blue columns on the right side of the grid. If you're considering trading on an even digit like 4, check if even digits overall are underrepresented in that market. A value below 45 in the even column would confirm this bias, strengthening your signal. Now for the crucial step, trade timing. Don't place trades immediately upon seeing these patterns. Watch the grid for at least 3 to 5 minutes to see if the pattern persists. Different markets update at different speeds, with 1-second indices changing faster than standard indices. You want to ensure the pattern is stable before trading. Let me walk you through a specific example of identifying and executing a trade. Let's say I notice digit 3 on the 75V market has a count of only 2, highlighted in red. I monitor this for about 3 minutes and see it remains consistently low. I also check the odd column and see a value of 43. Confirming odd digits are underrepresented. This is a strong signal to place a digit differs from 3 trade on the 75V market. To place this trade, I'll set my stake in the bottom right corner of the screen. For beginners, I recommend starting with 1 to 2% of your account balance. Then I simply click on the cell where the 75-volt row meets the digit 3 column. The system will automatically place a digit differs from 3 trade for me. Let's look at another example, this time for even-odd trading. I notice the 101's market shows 60 in the even column and 40 in the odd column. This 60-40 split represents a significant bias toward even digits. After monitoring for a few minutes to confirm this pattern persists, I can click on the odd column for this market to place an odd trade, betting on mean reversion. For best results, focus on markets with clearer patterns. The 50V, 75V, and 100V indices typically show more defined statistical anomalies than lower volatility indices. The 1-second markets can offer more frequent trading opportunities, but may be more volatile. Now let's talk about money management. Consistency is key to long-term success. Keep your stakes at 1 to 2% of your account balance per trade. After gaining experience, you might implement a win streak adjustment. After 3 consecutive winning trades, increase your stake by 50%, but return to your base stake after any loss. Always set a maximum daily loss limit. I recommend 10% of your account balance. Once you hit this limit, stop trading for the day. Similarly, set a profit target of 15 to 20%. Reaching your target is a good time to take a break and protect your profits. Keep detailed records of your trades, noting which digits and markets perform best with this strategy. You may discover that certain digits consistently outperform others on specific markets. As you gain experience, you can explore advanced implementations of this strategy. One approach is the dual confirmation method, where you only trade when two or more markets show the same underrepresented digit. For example, if digit 7 has low frequency on both 50-volt and 75-volt markets simultaneously, this might indicate a stronger signal. Let me emphasize that this strategy is based on statistical probabilities, not certainties. Even the strongest signals will sometimes fail. That's why proper money management is just as important as the strategy itself. During your first week, practice with minimum stakes until you've proven your profitability over at least 50 trades before considering larger positions. This will help you develop the discipline and emotional control needed for long-term success. Let me also point out common mistakes to avoid. Don't chase losses by increasing your stake after losing trades. Don't overtrade. Quality signals are better than quantity. And don't ignore your predefined risk management rules, even when you're having a winning streak. The Digit Pattern Divergence Strategy gives you a structured approach to finding high-probability trading opportunities using the LDP Binary Digit Pad. By focusing on statistical anomalies and implementing proper risk management, you can potentially develop a consistent edge in digit trading on the Deriv platform. Thank you for watching this tutorial. If you found it helpful, please like and subscribe for more trading strategies. Drop your questions in the comments below, and I'll do my best to answer them. Happy trading!